Hello, everybody. Welcome to Adding Zeros. Today, we have an extremely interesting topic to talk about. It's zero bias investing through ETFs and index funds. And we have a distinguished line of speakers today to talk about this topic. A panel probably best fit to describe what we're going to talk about today. So let's get our speakers on board first. We have Mr. Sanjiv Shah with us today. Sanjiv is the pioneer who introduced passive investing to the Indian investor. Sanjeev holds an MSc Economics from London School of Economics and FRM from GAR. He worked at Merrill Lynch for about 14 years at the beginning of his career. And then he co-founded Benchmark Asset Management in 2001. And that was later acquired by Goldman Sachs, where he served as the managing director. He served as member on several industry-wide committees, formed to deliberate on better functioning of Indian financial markets. A truly pioneer when it comes to index investing and passive investment landscape in India. Currently, Sanjeev has set up a couple of fintech ventures, OnePay and OneMove, etc. So really looking forward to insights from Sanjeev. A warm welcome to you, Sanjeev, and welcome on board.
Thank you. Look forward.
Thank you. My next speaker is Anil Ghelani. Mr. Ghelani is the head of products and passive investments at DSP. He's a CFA charter holder with over 2 decades of experience, and he's been with the DSP family for nearly 2 decades now. He's been a volunteer with the CFA Society India for more than a decade and currently serves as the vice chairman on the board. Anil has been instrumental in creating awareness about passive investing, and his views are sought after in the industry. Anil, warm welcome to you. Looking forward to speak to you.
Hi, thanks.
My next guest is Neeti Shah. Neeti is the assistant manager at Passives team at DSP, a chartered accountant. She has over 6 years of experience across varied roles. And Neeti is an integral part of the DSP passive investment team and has been instrumental in introducing a lot of strategies here. Welcome, Neeti.
Thanks, Sahil.
So we'll begin with this interesting topic on zero bias investing. And, just to kickstart, whenever an investor is introduced to the investment world, more often than not, we come with our own biases. And I think that leads to a lot of losses, that leads to, a lot of corrections and hit and trial in financial markets. What passive investments brings to the table is something very interesting, where, you could eliminate a lot of biases or actually introduce some biases which could, benefit you in your investment journey. So let me start off from a structural question. And Sanjeev, I'll come to you first. What is the idea behind passive investing? And what do you think, who is this investor who's fit for passive investing? And if you could take us through this universe and probably give us an overview of what is the industry globally right now. Sanjeev.
Honestly, everyone, in terms of which investor should be investing in passive. As a philosophy of investing, what is passive? Passive is basically saying that the markets know better than you, and you cannot know better than the market. And rather than basically spending a lot of time, energy, effort, cost of trying to basically say that I'm smarter than the market, why don't you basically take the returns the market is providing you? Because it's data shows that basically it's very, very difficult to beat the market. On an average in every year or every time frame you take, there will be some people who outbid the market, and there will be some people who underperform the markets because by nature the returns of the market are the same. So the problem which arises is that most of the people who outperform actually can't do it consistently. So the basic underlying philosophy is, you decide which asset you want to buy. And once you bought the asset, do not try and outbeat the returns on the market. So that's the basic philosophy of passive. Obviously, it's linked to efficient market hypothesis. And people talk about, the fact that, it's not really completely right because, you have a lot of arbitrages in the market and you have a lot of people who actually can, in a sense, make money, which is more than so-called alpha, more than the market provides. And, somebody can give an example that, basically, if, you're walking on the street and you see a 50 rupee note, as a efficient market hypothesis person, you shouldn't be picking it up because in theory, it never exists, right? But it does. And there will be some people who take it. But the point is, not everybody can do it, and everybody can't do it. And even if you're the most brilliant expert, you won't be able to do it consistently. So that's the basis of what passive investing is all about.
Sure, Sanjeev. Thanks for that. So if I could probably put one word in what you said, is probably this is a skill-based activity. Either you acquire that skill or hire that skill. Otherwise, you stick to passive investing, which will probably do the work for you because market is supreme. It can provide greater returns. Sanjeev, a follow-up question. What is the structure globally on passive investing? How is the industry shaping up globally?
So globally, if you look at it, the real, we all know that the indexing world really started in the 70s when Jack Bogle started the fund, which was basically called Bogle's Folly, the S&P 500 fund. Since then, it's taken off. The big flip came in the late 1990s and early 2000s when the market crashed in US, and that's when the passive investing started really taking off. But if you look into the last 7-8 years, the data and everything which people talked about as to why you should be investing, passive investing, has played out, and that's why it's become one of the largest fund structure in the US at least, and to an extent Europe, wherein you nearly have 50% of money now pouring into passive. In fact, last 2 years, more money has poured into passive than active. So structurally, the worldwide industry now is really becoming, if you want to call it, passive driven rather than active driven.
Right. So I think that's a very, very important number. 50%, and even last year, more than 50% has poured into passive funds. So it's really gaining, momentum now, and it's already has a huge critical mass. What Sanjeev gave numbers to. I'll come to Anil you now. So just to give you some, context in, let's say, Indian markets picked up passive investing when pioneer like Sanjeev came in and introduced this concept to India. So since then and now, what do you think is the overall landscape domestically? And is it fast evolving in favor of passives over time, Anil?
I believe very strongly that, as Sanjeev mentioned, passive investing is something which is meant for everybody, irrespective of which part of the world you are in. So I strongly believe that even in India, we have seen it catching up very fast. You said very rightly, maybe in 2001 or early 2000s when Sanjeev and a few others set up the passive journey for India, it took a little bit time for people to get warmed up to it and start investing. But now today, if we see entire asset management industry, we have about 12% of AUM, which is now under passives like the ETFs and index funds. So close to about 4.3 lakh crores of assets under management is now under the passives range of ETFs and index funds. And very important part within that is that in the very beginning, it was structurally very much institutional demand driven. We had a couple of large mandates by the government, the disinvestment mandates, and then there was the EPFO, the Employees Provident Fund. But in these last about 2 to 3 years, we have seen a very increased growth even for retail and HNI investors, wherein we have seen a very high level of interest coming in. And there are 1 or 2 key reasons for that. The first and foremost is the increased awareness that, yes, this is a good alternative to invest and it can give me a good way to allocate my core asset allocation. And the second key important part is that in the recent times, we have seen that the active funds have started finding it a little bit more difficult to outperform the index. So it has caused investors as well as their advisors to start considering and to start questioning that, am I doing the right thing by going into active funds? Or if for similar categories, there are passive funds which can give me better returns with lower cost. So that has been one of the main driver. But I feel very strongly, to summarize, Sahil, I feel very strongly that in India, we still do have scope for outperforming the market and generating alpha. In large cap space, it's becoming even more difficult. But in small caps, we still have a good space. But in large cap and to a certain extent in mid cap space, I feel that investors most certainly need to start looking at allocating funds into passive strategies.
Absolutely. So I think there is a maturity to the market which has started to, begin, and that is something which we have to be very cognizant about, because this is a space which has grown tremendously globally. And as Anil said, India is no different. We are also catching up and catching up fast. So, and Neeti, to come to you, we already, as Anil spoke about, there has been government mandates and other EPFO mandates which really kickstarted the debt ETF space and debt indexing space. I want to ask you about equity indices. What kind of equity passive indices and ETFs are available? What is the range and what are the options for investors today?
Sure. So I'm actually really glad you asked me this question, Sahil, because just about 4 years ago, before I entered the mutual fund industry, I knew of only 2 indices, Nifty and Sensex. I did not know of any other indices. But if you ask, say, somebody now, I'm sure investors are now slowly becoming aware of the range of indices that are available today, and that ETF and index funds, as the ecosystem evolves, it is really spreading awareness about the kind of equity indices that can be used to, create passive funds. So index providers, contrary to the kind of funds that they're facilitating, have become very active. Every day there are new indices coming out. And so just to give you a broad sense, equity indices that are available today, I can divide them into 4 broad categories, right? So the most commonly available ones, most popular ones are these broad-based indices. So your Nifty, your Sensex, which are market cap weighted, and a major chunk of the ETF and index funds that are there today in India are based on such broad-based indices. So they could be large cap indices, mid cap indices, small cap indices. And majority of the ETFs that are available today are based on such broad-based indices. Then you move to the other category of indices. So you have something called sectoral indices. Now, these are concentrated towards specific sectors of the economy, which means that, say, in the past 1.5 years or so, IT has done remarkably well, or metals as a sector has done remarkably well. So there are ETFs that replicate the Nifty IT index or the Nifty metal index to provide their investors exposure to such sectors, such concentrated sectors. Moving on, you have something called thematic indices. Now, these indices are constructed or centered around certain themes or trends that are expected to, play out in the future. To give you a very famous or very interesting example, ESG is a theme currently that is getting a lot of popularity globally and in India, with investors demanding, ESG considerations be kind of incorporated in their portfolios. So the easiest and the simplest way to do this today is to buy an ETF that replicates an ESG index. So there are these thematic indices that are available today that help investors, or somebody wants exposure to US stocks. Technology in the US is a big thing. So there are indices that are available today that can help investors gain access to international markets as well. So these are the thematic indices. And lastly, we come to a very different, a very interesting category of indices that are called strategic indices. Okay, and they consist of a slightly different and alternative weighting strategy that is used, that is different from the traditional market cap weighted indices. And their objective is not only to meet the market, but also to beat the market. So these are smart beta indices, as we call them today, which kind of combine both active and passive investing, and they try to beat the benchmark.
Sure. Thanks for that, Neeti. So if I get it correctly, so whenever you're indexing or doing a passive strategy, it will go and try and replicate an index, which is already there. For example, the Nifty 50 or the Sensex, which is, extremely in your face and everybody understands that. And then you spoke about other thematic indices, strategic indices. Sanjiv, coming to you, I think, as I said, there are very recognizable indices globally, which all of us know and understand. But then we move to the second step where we start talking about, let's say, mid-cap passive investing. We want to move towards a more strategic or more niche areas. So I want to specifically ask you about, let's say, mid-cap passives. What is the overall landscape here in terms of mid-cap passives? Do you think there is a merit in going down, let's say, in terms of market cap, or looking at these indices as a strategic asset allocation in your portfolio?
So, from my perspective, really, you should be invested in the whole market. Now, if you look at, the largest funds in the world today, it's a Vanguard fund, which basically is an all market fund. It's nearly about 1.3 trillion, 1.4 trillion. And I think that's the best way to go. But in India, you obviously don't have many funds like that. So the ideal route would be you buy the Nifty, you buy the next Nifty, as we call it, the index. And then you go to the mid-cap space and maybe the small cap space based on the asset allocation which you typically have. And this, all of them put together, would give you a full market return. So I'm a complete fan of investing in the full market, and because of which I am also very I really believe that you should be invested also in the mid caps and the small caps in the market. And I, as a believer in passive, obviously believe that you should be invested in indices and the structures which are available in terms of ETFs or index funds in the passive space. But yes, to answer your question, you should go down the route of the mid cap and the even small cap, ideally through passive. And I'm a firm believer that you should not miss out on any part of the market when you are an equity investor, and that's why you should be invested.
Absolutely. Anil, coming to you, Neeti spoke about smart beta and factors, which looks at slightly different way of allocating funds following an index. So in India, what do you think are the key factors which are available, and which one investor should look at, particularly when you look at different market caps, whether it is large, mid, or small? What are the factors that you think are important in India?
Structurally, when we look at factors, or to simplify it, what we mean by saying factors, for some people to just get to understand that. So whenever we slice the risk and returns characteristics of any asset class or any security or any index for that matter, you can slice it into different components which can be defined as factors. So something similar to like if you are looking at some food, you can slice it into this much protein, this much carbohydrates, this much fat. Similar to that for each asset class. So you can have factors such as momentum, volatility, growth, value, quality. So I feel that when we are looking at large cap stocks or the large cap universe, each of these factors can play a very important role in different parts of creating your portfolio. For example, in India as a market or most of the developing markets, very often we find that momentum as a factor does very good, except of course when there are points of inflection in the market and there is a sharp turn and the cycle is changing. But otherwise, structurally, in general, some of these factors like momentum or volatility structurally do very good. When we look at different part of the market capitalization, like for example, mid caps. For small caps, I don't even want to go there because, as I mentioned, I strongly believe for India, slightly different approach that for India, in small caps, still there is a need or a scope for active investing. But for, let's say, mid cap space, if you're looking at doing some kind of a factor-based investing, I very strongly believe that the key factor to look at in mid caps should be quality. Before you go to any other factors, like for example, momentum or value, quality becomes the first priority. Why? Because if you look at past data, whenever we are looking at the mid cap universe of this about 150 stocks, only about 15 to 20% stocks from that universe have grown to become large caps. It's not like a school that, okay, I'm in standard one, grade 1, then grade 5, then grade 7, 10, and I'll move out of school compulsorily and move into college. So there are many stocks which remained as mid caps or even slipped down further to become small caps. So in mid cap universe, there is very higher chance of this kind of so-called accidents. So it's very crucial to use quality as the first and foremost factor. And hence, I feel that whenever focusing on this space of mid cap, the quality factor becomes very important. And different people can define quality in different way. But one has to keep in mind that certain key pillars of quality, like in terms of the quality of earnings, what kind of earnings profile, the leverage that the company has taken for creating those earnings, and the variability of those earnings. Some basic elements of a good quality business should be factored into the picture.
Right, absolutely. Coming to that, I think in particularly, speaking about mid-cap quality, Neeti, any particular indices that can cater to a mid-cap quality kind of a theme, and what are the key features of such indices?
Absolutely, Sahil. So, in fact, there's the index that is called Nifty Midcap 150 Quality 50 Index, which applies the quality factor to the entire mid-cap stock universe, right? So the mid-cap companies are ranked 101 to 250 by market cap, and you apply a quality filter to those companies. This quality filter assesses purely quantitative parameters like the consistency of the earnings growth of these companies, or what is the return on equity these companies have provided, how high is the debt on the company's balance sheet, and then scores the company based on a combination of all of these factors, and arrives at a quality scale. So the companies that are ranked highest based on this quality score will form a part of the index, and it picks up the top 50 quality companies from a universe of 150 mid-cap companies. So this is a great way to get a flavor of quality within the mid-cap space.
Right, absolutely. Thanks for that. Next
If
question.
you permit, I'll take 1 minute in between, and adding on further to what Neeti said and carrying on further from what I mentioned. I like this particular approach because in mid-cap, again, I'm repeating, quality is very crucial, and I like to just take it with a very simple example, which layperson can understand and relate to. It happened with me recently. Somebody said, okay, nowadays you have started coming back to the office. Let's have a lunch together, and I want to come to your office in Nariman Point, and we'll go down to eat street food, roadside. Nariman Point pe kabhi aap aaye to, there is a lot of small stalls over there which serve good food on the street, and some of it is really tasty stuff. Now, when I have to select and invite that person to come and let's go down for the food, the first and foremost criteria for me has to be that I have to go to 1 or 2 such stalls where the quality of the food is very top class. Means I can't afford that the person is using some water which is not good, or some stomach infection or food poisoning comes up. The other part of the thing is different, that whether the food will be good taste, or that person had requested, I want to eat some Chinese roadside food. Okay, that is secondary. So my first port of call to identify is that, okay, usually when passing by, collecting all data, that I have always seen that these 3 stalls never have any water seeing over there. They always have bottled water being used. And you always have a lot of crowd across the lunch hours to these 3 stalls. So that becomes the crucial part to select first as a quality, and then later on the other aspects, or let's say in our case, like other factors like taste, cuisine, you want Chinese or Italian, right. Or in our investing context, whether you want growth stocks or you want to have stocks with low volatility or high momentum. But first, quality is the most crucial. If you're in large cap, suppose that person would have said, we'll go to the 5-star and have a very nice meal. Then I have no worry. Okay, we'll go either to the Trident or to the Taj President, whatsoever might be. So in mid caps, just to connect the dots to what Neeti mentioned. Sorry, I interrupted in between, but I just like to leave this example, on the table. Why it's so crucial to focus first on quality.
Absolutely. So in mid caps, I think there are a lot of variables which can, as Anil said, cause companies to either become big or small, and quality is the foremost to avoid any pitfalls. Sanjiv, next question to you, which is extremely important, moving on from mid cap investing, is this idea about the differentiation and, so to speak, competition between 3 types of passive: the index funds, the ETFs, and the fund of fund structure. So first is, I want to understand what is the difference between these 3, and what do you think is the optimum vehicle for investors, or all of them have different use cases?
So it depends on what kind of investor you are. So if your port of call is really the stock exchange broker, and you invest through them, then ETFs make immense sense, because you just keep it in go to your broker, buy the index ETF which you want to buy, and that becomes the best port of call for you to invest. Now, the advantage in terms of structure of ETFs in India is that basically, typically the tracking error is lower than an index fund, because you don't have to worry about keeping cash in the fund at all. But we can go into details in terms of why they're structurally better. But I would largely say that if you're going through a stockbroker and your first port of call for investment is a stockbroker, ETFs really make sense for you. If IFA is your first port of call for investments, then index funds make sense for you. Fund of funds is something, typically you'll have fund of funds because of the fact that you don't have access to those markets. I'll give you a good example that, if you want to buy, you have NASDAQ to be, bought in India. Typically you don't have foreign brokerage accounts. So Indian funds allow you to basically buy it because they created a fund of fund structure. So really fund of funds are a structure to allow you access to index funds, which you typically won't have access to. So, they are a little different. But in terms of ETFs and in terms of index funds, I would say basically you should be driven by your investment advisor, if you want to call it. Is it a stockbroker or is it IFA? And based on that, you should be buying. And if you're a new investor, let's put it this way, I would say that basically, start off with, going to an IFA because it's very simple, easy to operate. You can do SIPs and things like that. Invest in index fund. And you've been an investor for a long period of time. You know how the stock markets work. Then ETFs provide you a better structure in terms of tracking error. So that's how I would put it.
Absolutely. So I think, as you said, all of them have their own use cases. And for ETFs, as you said, if your first port of call is a stockbroker, then you prefer an ETF. It's an excellent structure to look at. And then index funds, of course. Anil, a similar question, follow up on this topic to you. What do you think are the liquidity aspect when we compare, let's say, an index fund to an ETF? And, if you could throw some light, being an industry participant and, so to speak, a veteran in managing these things, how should an investor look at when he sees these two different buckets? What is appropriate for the investor, how to choose? So if you could throw some light on that.
As an investor, when you're looking to choose, bear in mind that the risk and return objective or outcome for both ETF or index fund is going to be very similar. It's just the way to access it. So in case if you are, as Sanjiv mentioned, comfortable and you have a trading account, demat account, then yes, ETF route becomes much more a superior approach in that sense, because you can have it in your control. You can buy the ETF intraday at any point of time in the market that you want, and you can hold it conveniently along with your other holdings in your demat account with your broker. If you want to invest into index funds, it does not offer you this kind of intraday entry or exit, but certain other features are there and benefits. Like, for example, you can do very conveniently SIP, you can start, or you don't need to worry about looking at the particular broker account and managing that. Suppose you don't have a broking account and demat account. See, Sahil, very often we talk to many investors. They could be having a lot of legal constraints and requirements, especially people in our financial services side, or there are large institutional investors as well, let's say, who are PF trusts or some certain companies. They have a mandate that they can't open a trading account. So for them, the index fund route becomes much more comfortable and easy to access the underlying investment strategy. So safe to say that structurally, yes, ETF is more superior for certain set of investors. And in other ways, index fund has certain benefit, which some set of investors would find it more useful to allocate money to. And in terms of liquidity, it's a very important thing, and a lot of debate keeps happening on that. I would just like to highlight two things. For index funds, you don't really need to worry because you give your redemption or subscription to the portfolio, to the asset management company or to your IFA or to your distributor. And then it's our responsibility as the fund manager to raise the liquidity and give you the redemption proceeds or invest your funds. In the ETF, you have to go on the stock exchange and then buy or sell your units. Of course, unless you are a very large investor, you can directly trade with the mutual fund house as well. But in ETFs, one of the key things to keep in mind when you're looking at the liquidity is the health of the order book or the depth in which the market orders are placed. So very often I get raised this question that, you listed one ETF a couple of weeks back, and the traded volume on the ETF usually is like about 1 crore, 2 crore size in terms of value. What if I want to enter with like a 5 crore ticket size? So I always keep saying, these are the 3 key things of any ETF to be successful, that your underlying needs to be large, liquid, and transparent. As long as the underlying assets which you are investing in are large, liquid, and transparent, there is no issue at all, because there will be market makers standing on both sides with bid and offer quotes, which will very comfortably absorb your liquidity because the underlying is very conveniently accessible. So at all points of time in an ETF, the main thing to look out for is, of course, you should look at many things like the traded volume, like the tracking error, etc., and various subjective factors like the comfort with the fund house, do they have dedicated team, etc. But from liquidity perspective, it's important to look at not just traded volume, but the depth of the order book. How many number of bids and offers are standing? What is the total, which you can see very easily on the NSE or BSE website or on any of your trading portal.
Sure. So it's
the top 5 bids might be small, but the total bid and offer, like the depth or the health of the order book, is the most crucial to look at.
Right. So it's not a binary question, as Anil said. I think it's more dependent on when you look at the deeper aspects on how much liquidity and what is the order book, that we come to know how suitable is that in terms of our order size. I want to ask 2 very, very basic and fundamental questions to the panel. Neeti, I want you to probably give us a very brief overview, sort of a walkthrough on how passive fund manager looks at an index and then replicates it. What are the first 1 or 2 basic steps for investor to understand?
Okay, so interesting question. So when I look at, replicating an index, the first thing that I would need is how my index looks today in the morning. So we receive, we have the index constituents and the weights that are there today morning, and we try to every day. So the constituents are going to remain the same in case of passive investing. The idea is that you buy and hold. So the rebalances or the change in constituents happens, say, once in 6 months. Right. So the constituents are constantly remaining the same. The only thing that will change are the weights of the constituents, and that is purely on account of price movement of the stock. So every day your portfolio is almost automatically aligned to the underlying index that you have in the morning. What you need to keep in mind, of course, are the slight nuances and intricacies. Say there's a corporate action, there's a dividend that goes X in any of the stocks in the index, there's a stock split happening, or a bonus being declared. So these are the things that you need to monitor in order to kind of change your portfolio and have it exactly aligned to the index.
Absolutely. Thanks for that. I think that will help a lot of people understand how we replicate that. Another, Sanjiv, basic question coming to you is, where does the cost efficiency for passives get built? What are the various ways where it saves cost over, let's say, an active investing or people who are trying to create their own portfolios?
No, first is obviously the fact that basically your fees. Typically, from the investor's side, when you're investing in an active fund, typically you'll end up paying about 225 basis points. That there's been a pressure on that from all across. So, you've seen the fees are active coming it down, but really speaking, it's coming through that. The second aspect, this is for the investor. Right. From the fund manager's perspective, the cost goes up because I, as a fund manager, when I have to basically identify new companies, I have to go out, check them out. There are costs involved. The number of people who I have to employ to basically get that information for myself entails a cost. My cost in terms of having people, cost in terms of time, cost in terms of how I actually evaluate that information. Now, one of the biggest advantage in index fund is all that is basically provided to you by the index provider at a very, very specific nominal cost, very low cost at that, and that's why your ability to run the fund at a lower cost is high. For the investor, that's why if you look at an index fund, the fees are far lower as compared to the active fund. The difference nowadays is nearly close to 150 to 175 basis points. That's where I think even if you look at the alpha generation, even if I'm damn smart and I actually create alpha over the market, the cost will actually kill me. because to generate extra 150, 175 basis points is not as simple as it sounds. So, and because I'm putting on little more weight on myself, I'm carrying a heavy backpack on me. So these are the basic differences in terms of where the costs are coming through, A, for the fund manager, and B, for the investor.
Sure. Sanjiv, I have a specific question from Madhusudan Thakkar specifically for you, where he asked that what has been your experience when these products are offered to customers? Or investors? Are these funds suitable for IFAs and MFDs to recommend, for example, the passive funds to what kind of investor, new investor or existing investor? What has been your experience?
No, as I said at the beginning of this our session, that it is for all investors. Now the question arises, especially for IFAs, is that how do I typically right now what happens is the fees when you sell a fund are provided by the fund manager, which is the product provider, if you want to call it, and it's kind of subsumed in the fees the investor pays, and I collect it from, if I'm IFA, I collect it from the product provider. Now, there is an agent principal problem there. And that's why one of the biggest problems which is faced by IFAs is if I actually tell my clients to buy index funds, where do I get my fees from? Even though I'm giving the right advice, it becomes a problem. And it's a fair question. And if I'm an IFA, I have to earn my living. And how do I do that? And that's why my advice to people is that basically, you should be the agent of the investor and not of the fund, which would mean that you should collect fees from the investor and not from the fund. Now, it's easier said than done. People have this, any individual doesn't want to pay, even if it's, subsumed in the total cost, I'm okay with it. But I think that's an effort people like us have to put in to tell investors that it's better to pay the IFA who's giving you the best advice for yourself, rather than basically paying subsumed fees. To answer Madhusudan's specific question, yes, I think index funds, and try and take the fees from. I'm preempting his next question by saying that try and take the fees from the investor.
Absolutely, thanks for that, Sanjiv. And then next question to you: when we look at the whole gamut of passive investing and index and ETFs which are available, is it possible to create a portfolio using just using passives? Because in India, a lot of investors are either only fixed income investors or only equity investors. And now, over the last few years, we've seen that portfolio allocation, asset allocation has started to pick up trend. Is it possible to use only passives and create a good portfolio asset allocation for yourself?
Oh yes, absolutely. So today we have got ETFs and index funds for almost everything that you want. We have got the broad indices, like Sanjiv mentioned, by the full market. So you can do with, let's say, the Nifty 50, Nifty Next 50, let's say Nifty Midcap with the quality focus. So that covers your overall equity component. Then we have got certain funds which will give you allocation to fixed income. We have got certain funds which will give you allocation to gold as a commodity. Now, of course, gradually we will be soon having silver related ETFs as well. So, and then of course there are these funds which offer you exposure to international markets as well, the global funds as well. So through the route of buying passive funds, one can very easily structure a good asset allocation mix for your client's portfolio or for yourself if you're a DIY type of investor, and you can create your own portfolios. But yes, most certainly this kind of approach is very much feasible now for us in the market. And I think then that's where Sanjiv's point comes in, that if you are in a position where you can pick and choose these kind of building blocks from the industry, and that's where you will showcase your value add to the investor and charge the fees to the investor. I mean,
right.
So yes, it's very much there, and as we speak, it's evolving even more bigger and better and faster.
Sure, thanks for that. Neeti, coming to you, I have an audience question. I'll take one or two audience questions also. There is a question saying that why does passive fund not pick, let's say, inexpensive stocks or stocks which are cheap? So I want to rephrase that to you and ask you, what are the methodologies which, let's say, a passive fund deploys? Does it reside at the index manufacturer level, or are there any changes that can happen?
So passive by definition means that there are no active stock decisions taken by the fund manager, right? So whatever index comes, which is constructed primarily by the index provider, is exactly replicated by the passive fund manager, right? So the passive fund manager, there is no human, there's no element of subjectivity at all in terms of stock selection, in terms of weight allocation, in terms of sector allocation. Everything happens at the level of the, the index itself and the index provider. So yes, so there's no.
Basically, it's driven by the index provider itself, and so there are no changes which can occur at the end until and unless the index itself undergoes a change.
Okay.
Right. There is another question, Anil, probably to you. What is the basis on which these indices are rebalanced, and what are the timelines? Is it like a quarterly rebalance, 6 months, or are there any preset basis?
All the indices are very well defined and they are rule based without any human bias. So even the rebalance frequency and the rationale or logic for that is rule based. So for most of the indices, it is 6 months, once in 6 months. Again, the dates are predefined. For certain indices, it's always March and September end. For some, it's June and December. But it's upfront, clarified, predefined. And the rules engine or the model which goes behind determining the stocks which could be included or excluded, or whether the same stocks would continue, that also is very much defined in a robust way and works without any human bias.
Absolutely. Sanjeev, I want to ask you a question which I have in mind for a very long time. And there are certain market participants, like let's say Howard Marks, who've raised concerns saying that, because passive investing has become so big in size, not many market participants or investors are pricing stocks. They are just picking stocks which are there in the index. There is the research and the ability to price a security is going down. And eventually it will reach a tipping point saying that, passives will drive the market either up or down to a very large extent. How far is this argument accurate? And or what is your take on this whole hypothesis?
No, it's a good argument. But the reality is that basically at the end of the day, how does a stock come on to say, how does a stock get IPO'd? An index doesn't get IPO'd, a stock gets IPO'd. So the reality is basically you still have many more active members who basically look at stocks in a manner to basically say that this particular stock looks good and I'm going to IPO this company, or I'm not going to IPO a company, I'm going to take it private. And that actually fuels a lot of activity in the stock itself, and that actually allows you to do the pricing. Now, the second part of the whole equation is also that, what's really happening is in terms of the whole market, kind of a barbell world is developing. So, you have the passive index, which basically, one side of the curve is becoming bigger. And on the other side, you also have very, very active algorithmic trading or hedge fund kind of structures, which are basically looking at value in their own way and creating structures. The one in the middle, which is basically the pure active guys who basically we call them the index huggers, who basically, invest 80% in index and the rest, try and outbeat the market. Those are the people who are getting priced out and in terms of, not becoming very important. But the large barbell, which is on the other side, which is pure, very, very active, still, determines and allows the pricing to take place. So I wouldn't be worried about Howard Marks' remarks in that sense.
Sure. I think that's a very insightful answer in terms of how you describe that, active universe is also becoming larger and passive is also becoming larger. The guys at the margins are getting, priced out. That's an insightful answer, Sanjeev. Thanks for that. Anil, you've been a, market participant for a very long time. And I also come from a wealth management background. I've seen a lot of people doing arbitrage on Nifty and also trying to replicate indices. And when we have occasions of huge market volatility like 2020 or 2018 in various episodes, we've seen that it becomes very difficult even for people who are very, very trained, to trade in the market. How efficient are, let's say, an index funds and ETFs in phases like that? And are they useful to take advantage of such market episodes?
Oh yes, definitely. We can always have such kind of scenarios where I would say one step forward, not even in very extreme market scenarios or volatile scenarios, even in normal scenarios, or even when BAU is happening and some large results are expected or some event-based activities expected, even during those time periods, there is a very good use case by arbitrageurs and people who are running a prop desk to make use of the ETFs, because there can be an opportunity to get good levels of spreads, or they can have good opportunities to lock returns and use ETFs in a very efficient way and connect that with derivative contracts and underlying cash stocks. So that's a very healthy and very active market. But of course, like I think for this, I completely agree with what Sanjiv had mentioned earlier, that these kind of activities are very much feasible in the broader market indices, like for example Nifty 50 as a bellwether index, because there is a F&O available, the underlying stocks are available. So in these kind of ETFs, most certainly and very efficiently, this can be utilized.
Great. So I think we have come to an end of what we wanted to discuss today. So let me just paraphrase and try to contextualize what we discussed. That passive industry has already reached a critical mass. It's already now also getting into a very good momentum where a lot of assets are flowing in, and the benefits are already for all of us to see in terms of costs, in terms of tracking, in terms of availability of different types of investment avenues. So all of that is available, and it is for all investors, whether they are retail, institution, and it doesn't matter what type of investor you are. There is some passive product which is suitable for you. Sanjiv, any last comments from you in terms of investors who are looking to start their investing journey, because there are a lot of new young investors on the horizon? What would be the, let's say, playbook for them for the next 5 to 10 years?
No, I would definitely urge them to look at indices, buy the whole market. If they believe that basically, I want to also partake in the growth of smaller companies, yes, you will have indices which look at small cap, mid cap, and what have you. Some people might think that basically, I don't want to be invested in the whole market. I only want to be invested in a particular sector, say bank or pharma, because I like that or whatever. I mean, each one, comes up with his own themes. Then I think, you also have indices and funds which actually, focus on this kind of investment. But most important, I think, each and every investor who's coming into the market, please invest. I would not, if you want to invest in active, please go ahead. I would urge them to invest in passive, because in the 10 years time, you'd really save about 10% of your portfolio, but that doesn't matter. But definitely invest, period, full stop.
Thanks for that. Thank you, Sanjiv, for your time and for your insightful take on passive investing. Thank you, Anil.
Thank you very much, Sahil,
for insights, and thank you, Neeti, and thank you everybody for joining in today. We'll see you with another episode soon. Thank you.
Okay, thank you very much. Bye.
Thank you. Bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.